As investors, we like to put lots of different labels on stocks. You've probably heard the terms growth stock, dividend stock, value stock if you've been around investing for some period of time. And today we're going to be diving specifically into growth stocks, what they are, what they do, what to look for, what to avoid. And today I have a classic example of a growth stock, NVIDIA. It's probably one of the more extreme ones as well. Basically, everyone's heard of NVIDIA stock at this point. I don't think this is something groundbreaking, but they are a stock that has grown crazy good over the last 5 years, up 2,500%. It's the home run. This is the grand slam. This is kind of, if you're investing in single stocks, you don't expect any of your stocks to do something like this, but you hope that one of them maybe could. And NVIDIA happened to do this. They're now one of the 3 largest public companies in the entire world, up there with Apple and Microsoft. They've done extraordinarily well. But we can look at it as a growth stock, right? It's has a fairly high PE ratio above S&P 500 is usually the metric. This one is significantly above that. Good growth. You can see that with reflected in share price, but you can also see it reflected in the specific earnings, which we're not going to look at today. But with all these stocks, you'll see revenue growth, earnings per share growth alongside that. And of course, like I said, growth on the specific company itself. So the main thing you're trying to get, not that they can't pay some form of dividend, or not that they have to be crazy expensive, but the primary thing you're trying to get from a growth stock is the growth in the share price itself. And we can see another example of that. Arista Networks is a decent example of that, maybe a little bit less extreme. Don't pay a dividend, PE ratio in the 50s as well, up 800%. This is a good example of, okay, if you're buying a growth stock, this is kind of what you would be buying into. And now you may say, why would anyone want to do that? The PE is crazy high. Well, it's performed well. And that's part of the reason, right? Of course it's going to be more expensive than the S&P 500 if it's performed, over the last 5 years, this one's performed 8 times as good, more than 8 times as good. So you would expect it to be more expensive, because who wouldn't buy a company that's performed 8 times the S&P 500 and it's cheaper than it? Its PE is going to get pushed up. It's going to be more sought after. There's going to be higher demand to buy it, less people wanting to sell it at those levels. But you also have to make the calculated risk that, okay, if this stock stops growing at the rate that it is, right, which is, it doesn't have to grow, 800% or something like that. It just doesn't. But if this grows at the rate of a normal company, it's going to be priced like a normal company. If it's priced like a normal company, this PE rate is probably going to be cut in half. So that is a risk you are taking with growth-specific stocks, growth stocks, especially the ones with high PE, is, okay, if this stops growing at the rate that it is, you're going to have some downside. That's just reality. But if it keeps growing at the rate it is, you're also going to do very, very well. That's why diversification is key. I know you can find ETFs that are primarily growth. I own some in my 401k. I don't know off the top of my head. Ticker for it, I know Vanguard. Basically, everyone offers one. You can do some research to search high growth ETF, something like that. I'll cover some on the channel in the future. QQQ is a decent example, but it's more tech centric and it's not all just growth. There's plenty mixed in as well, but it is a growth centric ETF, right? And we can take another look. Here's Wingstop. This is, in my opinion, an example of a growth stock I personally wouldn't want to hold. Not that it's terrible, but I don't think I'd be holding Wingstop. See, the PE is high, 96. I know they aren't just focused on maximizing earnings per share, maximizing profit margin. I understand that they're focused on growth. And they're up. They've done well, 300% over the last 5 years. But also, what they do, I think part of the reason the PE is so high is the industry they're in, right? Wingstop, there's not a whole lot of fast food chains that are growing at the rate they are. Maybe off the top of my head, Chipotle's done pretty well. But there's not a lot. So if you want growth stocks in this industry, there's only a couple. And so kind of the money all piles in. But it's also kind of bad, because would you rather have a growth stock that's centered on data centers like ANET, Arista Networks, right? That's one of the most important growth tech things in the world right now, data centers and AI. So there's a lot more room to grow, in my opinion, than something like Wingstop. I like the industry better. So you got high PE, you have not as much growth, and you have an industry that, in my opinion, I'm not particularly high on. So Wingstop, in my opinion, is a growth stock. And it would be fine if it's diversified, but I would not put any large percentage of my portfolio in Wingstop, and I probably wouldn't own it outright almost ever, at least at this price, in my opinion. That's my opinion. If you like it, that's a different. But this is an example of something where I think the risk-reward ratio is off. Something like ANET would be much better, or NVIDIA for that matter. And then, like I said, not every growth stock has to fit into a category perfectly, right? Value doesn't have to be the cheapest stock ever. Dividend doesn't have to have the craziest dividend payment ever. And growth doesn't have to be insanely high PE either. I think TSM falls into that growth category, up 256% over the last 5 years. It does pay a dividend, so that's unique for it, 1.5%. It's above S&P 500 dividend. PE ratio is a little bit above S&P 500, but it's at 31. S&P 500 is at about 27. So we're just a little bit above it. So this is probably a growth. Would you say like, oh yeah, this is pinnacle growth stock? No. But if you had to label it, you could label it with growth. That's probably where I'd label it. It's not a dividend stock, and it's not a value stock. And like I said, all the labels aren't perfect. There's some stocks that fall into none. I think McDonald's is a good example. Hasn't grown well enough, isn't cheap enough, and doesn't pay good enough dividend, right? Not that it's a terrible company either. But not all these stocks fall into specific categories. So hopefully this helps you understand what growth stocks are. Hopefully you can kind of feel, hey, this is what they're good for. The biggest risks with them growth-centric stocks is if they slow down. That's the biggest risk. If they grow like a normal company and the PE is high, you're going to lose value on the top end. But also there's immense reward. If they keep growing, you're going to do very well in these stocks, and they have a track record of growing. Just make sure if they're borderline, or it can also get messy if they aren't profitable, because it could be, oh, this share price is growing up a lot. But if it's not backed by some level of earnings that you can match it to, people can buy in at prices they don't truly understand the value of what they're buying into, and they can lose a lot of money. You see that, for example, in NIO when it went up a lot in 2021. People don't really understand the price that they're buying into, and then it fell down. Not that that company can't do good ever, but that's an example of one where it was not particularly great. So I'd be careful of companies that aren't profitable. I've covered that topic on my channel, but I've covered most of what I want to in this video, so I appreciate all of you for watching. If you enjoyed, leave a like and subscribe, and I'll catch you next time.